Okay, let's start with the last topic. So now we are dealing with currency exchange rates. Well, currencies is a very tricky subject as such. It's one of the largest financial markets. The daily volume is more than $3.5 trillion in international markets. This is as per the Bank of International Settlement data. So globally, we trade in multiple currencies. Now we've started from barter system to gold-based system, and now we have fiat currency. Of course, in the future, what we are seeing, and in fact now in the present also, what we see is that after a very long time we being dependent on the hard currency, that is the fiat currency, we now are moving to digital currencies with cryptocurrencies and blockchain technology. So that's what the transformation of currency has been. Many famous currencies like dollar and euro, pounds, yen, rupee, dirham, they have been dominating the global trade. And at one point of time, it was said that if there is going to be the next world war, it's going to be on currencies. Well, I believe that the next world war is going to be for water and natural resources. But currencies was said to be one of the most fierce weapon used in the international trade. So let's understand the basics of currency and the approaches of how currencies are managed in the global system. Okay, let's understand. So what is currency? Currency is nothing but exchange of one currency for another. It's a value of one currency in terms of another currency. That's what we call as foreign currency exchange, or simply said as Forex. It's a short form that we use. So the price of one country's currency in terms of another is what we call as foreign exchange or currency value, right? Now, let's say I have taken up an example of one AED. One AED means one dirham, Arab Emirates dirham, is 20 rupees or 20 INR. One AED is how much? 20 INR. Everyone with me? Correct?
Yes.
Can you tell me this is the rate of AED or INR? Is this the rate of
AD?
Yes, it is the rate of AED, right? Or dirham. So the currency whose rate is being quoted, in this case AED, is called the base currency. Clear? And in what terms is it quoted? It's quoted in terms of INR, right? So here the INR is said to be the price currency. Price currency is the currency in which the base currency is quoted. That's called price currency. Clear? Now, why is there so much of discussion and confusion about it? Let me tell you that, for example, 1 ounce of gold is, let's assume, $100 for simplicity. So this is the price of, what is this price of?
Gold.
Gold, right? Gold is the asset that we are talking. So it is the price of gold in terms of US dollars. So I can say gold is the base here, and in terms of dollars, so dollar is the price. So dollar is said to be the price currency and gold is said to be the base currency. Now you will say that, sir, there is no currency. Gold is not a currency. It's a commodity. Yes, it's a commodity. But it becomes confusing when there is a currency. Because why? See, in commodity, the value of commodity is in terms of a currency. But the value of one currency is also in terms of another currency. That's where the confusion becomes. And that's where it's necessary to understand what are we talking about. We are talking about the base currency in terms of price currency. So always and always and always, we are talking from the point of view of base currency in terms of price currency. So we talk what is the rate of dollar in terms of INR, what is the rate of dirham in terms of INR, what is the rate of pound in terms of dollar, what is the rate of Australian dollar in terms of dirham. So basically, what are we talking about? We are quoting the rate of base currency in terms of price currency. Everyone clear? right? Now, imagine a situation that you are a citizen of India. So you go to your local bank. The banks will display you the rates of various currencies. Will the bank tell you that these are the rates of INR, Indian National Rupee, or will it tell you that these are the rates of foreign currencies in terms of INR? So will you get to see there the rate of dollar, pound, euro, or will you get to see the rate of rupee? What exactly are you going to see when you go to the bank, the rates of? Are you going to see the rates of foreign currency, or are you going to see the rate of your currency? What is going to be the base currency?
Foreign currency.
Foreign currency, right? So when you go to your local bank in Canada, you will see the rate of INR in terms of Canadian dollar, right?
Yes.
Which will be 0.0 something. Clear? But when you go to your bank in India, they tell you the rate of Canadian dollar in terms of INR, isn't it? So when I go to Dubai, I ask them what is the rate of dirham. They tell me no, we have the rate of rupee. Got my point? But when I go to the Indian bank and I ask them what is the rate of rupee, they'll start laughing at me. They'll say, no, we have the rate of dirham in terms of rupee. Are you getting my point?
Yes.
So what is the conclusion here? The conclusion here is that when you are getting the quote of foreign currency, where foreign currency is the base currency. Foreign currency is base currency. In such a situation, that type of quote is called direct quote. Okay, so when I go to an Indian bank, as an Indian citizen, when I go to Indian bank, I will get the rate of dirham in terms of rupee. This is a direct quote for Indian or for UAE citizen. It's a direct quote for Indian trader.
Indian trader.
Right? But the same code will become an indirect code for a UAE citizen. Why? Because you are in UAE and you are not getting the quote of INR, but you are getting the quote of your currency only. That's a bit awkward, right? That's called indirect quote. What happens in indirect quote? Think of like a UAE citizen. Here, your base currency is what? Your domestic currency. Are you getting it? So when your base currency is foreign currency, it's called a direct quote.
Direct quote.
And when your base currency is your own currency, domestic currency, which is a bit awkward, it's called indirect quote. Clear? Most of the times you'll get quotes in terms of, in fact, all the times you'll get quotes in terms of what? Direct quote. So as I said, when you go to your local bank, they will give you the rate of foreign currency in terms of base currency. Is that clear? So foreign currency in terms of your foreign currency will be your base currency, I mean. So foreign currency will be the one which will be quoted. Clear, everyone? So tell me one thing. Everyone, this is a question for everyone, okay? If I say $1 equals to 3.50 dirham, is this a direct quote or indirect quote? Is it a direct quote or indirect quote? Come on.
Direct.
Direct.
Well, I have not given you where this quote is. How can you say it's direct or indirect? I have not told you where this quote is. If now I tell you this is the quote in a bank in USA, then
Indirect.
it's an indirect quote because in USA, dirham should be the base, right? Correct? So it's an indirect quote in USA, but it's a direct quote in UAE. Are you getting it? So whether it's direct or indirect, it is incomplete without I telling you where this quote is traded. So the location is very important in direct or indirect code. Are you with me on this, everyone? Got it, got it, got it. Everyone, clear? Yes or no? Tell me so that
Yes.
there are many such things. So if you don't get clear anywhere, let me know. So base currency is the currency which is quoted in terms of price currency. Clear? When your base currency is a foreign currency, it's called a direct quote. Otherwise, it's called a indirect quote. Clear? Now, if the value of the currency, which currency? We are always discussing from the point of view of
Base currency.
base currency. So I'll write here, always think from base currency only. What is the most important word here? Only. You're always going to think from which point of view? From base currency.
Base currency.
Clear? So in this equation that you see, I would like to highlight you one issue with the CFA Institute. Should I discuss that now? No, leave it. We will discuss that later on. CFA Institute quotes the rates in terms of price/base. It quotes the rate in terms of price/base. So for example, if I quote the rate as USD/euro, which one is the base currency here?
Euro.
Euro is the base. The second currency is the base currency. Everyone with me?
Yes.
So whenever you see a currency, you have to promise me one thing. I'll repeat. Whenever you see a currency quote, you have to promise me one thing, that the first thing you will do is highlight. You can just mentally highlight the base currency. So in this question that you see, which one is the base currency? USD or Euro?
Euro.
Euro is the base currency. Everyone with me? Correct. Yes or no?
Yes.
Now, at times they will tell you, at times they may not tell you. But even if they don't tell you, our student is prepared to understand that what is the base currency. Now, last year, the value of Euro in terms of USD was 1.25. Currently, the value has become 1.6. So has the value of Euro increased or decreased? Compared to last year, has the value of Euro increased or decreased? It's so easy to just see.
Decrease.
1 euro was available at 1.25. Assume Euro is a water bottle. If the Euro's value was 1.25 and now if the Euro's value has become 1.6, is the value of Euro increased or decreased? Increased, right? Very visible. Just assume currency as a commodity. Its value has increased. This increase in the value of Euro is called as appreciation. Increase in the value of one currency in terms of another currency is called appreciation. Everyone with me? Which can be due to various reasons. Maybe that the demand of your currency is high because of foreign investments or whatsoever. Is that clear?
Yes.
So can you tell me which currency has appreciated here? Can I say Euro has increased? So Euro has appreciated, but it also means that dollar has depreciated. Why? Because its value has gone down. So when the value of a currency goes down in a floating exchange system, floating means no government control, demand and supply decides the price. So when the value of the currency is going down, we say the currency has depreciated. Is that clear? So just first, what is the first step that you all will do, please, everyone? What is the first step that you all will do? It's such an interesting topic. Please don't get boring by not responding, everyone. I'll repeat. The first thing that you all will do is that you all will focus what is the base currency. Okay. The format that CFA Institute uses is price/base. So the second currency is the base currency. Okay. If the value of base currency is increasing, we say that the base currency is appreciating, or The price currency is
Depreciate.
Can you tell me how much was it before and what happened later on? What was the price of euro before? 1.2.
1.2.
Then it became 1.6.
1.6.
So can you tell me how much did the euro appreciate by? You know how to calculate, right? No? We've done so much
Yes.
equity price change. So here I see 1.6 by 1.28, 1.25. I can say euro has appreciated by 28% against US dollar. Am I correct?
Yes.
Or US dollar has depreciated by how much? I can say euro has appreciated by 28% or euro has depreciated by how much? Will it be 28% exact? No. That's what you need to understand. So I know euro has appreciated by 28%, but there is some problem due to which mathematically you cannot say that dollar has also depreciated by the same rate. Why? Because when you talk about dollar should be in the base. Now to make the dollar in the base, I will have to, if 1 euro is $1.25, then how much is $1? Can I say it will be 1 divided by 1.25?
By 1.25. Yes.
It will be inverse of it, right? So
Yes.
it will be 1 divided by 1.25. That will be the value of $1. I'll repeat, how did we find that? Initially, 1 euro was $1.25. Therefore, I want to calculate dollar. So dollar will be 1 divided by 1.25 euro, isn't it? In the same way, if I want to find the price later on, it will be 1 divided by 1.6. It will be 0.625. So what has happened to the dollar's value? It has gone down. So 0.625 divided by 0.8 minus 1. This is 21.87 negative. Are you with me? Are you understanding this? So if I say euro has appreciated by 28%, I will say that dollar has depreciated by 21.87%. Is it same? Well, absolutely not. Are you with me? So the conclusion for the same quotes, the percentage appreciation of dollar, no, the percentage of appreciation of, what is it? Euro, right? Euro was appreciated, is not the same as the percentage depreciation in USD. Clear, everyone? Are you getting this? Yes, no, why? Let me know.
Yes.
This is very unique thing. 3 things I've discussed here. What is base and price currency? What is direct and indirect quote? And what is appreciation and depreciation? Under all the discussion, my focus is always on the base currency. We are talking always about base currency in terms of price currency. And what is the format that CFA Institute uses? What is the format that it uses?
Price by base.
Price/base. Okay, where it is the second currency is the base currency. Is it clear, everyone? And the most important conclusion is that when one currency appreciates, definitely the other currency is depreciating, but not by the same proportion. So if they tell me which currency is depreciated here, which currency is depreciated? USD, right? So
Yes.
USD should be in the base. If USD is not in the base, first make it in the base and by inversing it and then calculate. Otherwise, you are doing mathematical error. Clear? If they tell you which currency is appreciated, euro is appreciated. Is euro in the base?
Yes.
Yes. So you don't have to do inverse. If euro was not in the base and if they ask me anything about euro, then I have to inverse it. Clear, everyone? Very important. Any questions, anyone in this? Okay. That was one very important point. Now let's go to the second part of understanding nominal and real exchange rates. Now from economics as well as from QM, you know what is the biggest difference between nominal and real?
Inflation.
Yes, from the Fisher effect, you know it is the difference of inflation. So if inflation is increasing, what will happen to your currency? Its value will, what will happen to your currency? Its value should,
Depreciate.
yes, its value should fall, right? Its value should be lower. Clear?
Yes.
Now, this is what we are going to understand. So nominal exchange rate is a simple exchange rate which tells you number of units of one currency for another currency. So nominal exchange rate tells me how many number of domestic currency I require to purchase 1 unit of foreign currency. It tells you how many rupees you require to buy 1 dirham. Correct? That's a nominal exchange rate. But real exchange rate is different. It tells me how many times more or less goods and services can be purchased abroad after converting domestic into foreign currency. Now, this is interesting. So let's say I have to buy an iPhone from UAE. Okay, I have to buy an iPhone from UAE. Now, if I sell some rupees, if I convert rupees into dirham and then go in UAE to buy an iPhone, what will be the value of that iPhone for me in terms of rupees is called the real exchange rate. The real exchange rate deals with the actual value of goods and services bought from abroad, not only the exchange rate. See, the nominal exchange rate just tells you the difference between two currencies exchange rate, right? It just measures the numerical exchange value. But does it tell you that whether the goods are costlier in one country relative to other? Well, it doesn't tell you. It only tells you when you, let's say you buy an iPhone from India at 1,000 rupees. But if you convert this 1,000 rupees into dirham and then go into UAE, and what if you get iPhone at a higher or lower value? Then that's called real exchange rate, the value at which you actually get the goods. So real exchange rate measures the relative purchasing power. Are you with me? I'll repeat. Which
Yes.
currency takes into consideration the real value of goods when you buy from abroad or sell abroad? That's real exchange rate.
Real
not
exchange.
exchange rate. Okay. So how do I convert a real exchange rate from the nominal rate? Well, in the nominal exchange rate, you have to apply inflation. Inflation of foreign currency with respect to domestic currency. Now, first of all, inflation is wholesale or retail inflation. Retail inflation is called CPI, Consumer Price Index. You recollect that? So if you see the formula here, real exchange rate is nominal exchange rate into inflation of base currency divided by inflation of price currency. So now let's assume that currently the rate of 1 dirham is 20 rupees. How much is it? 20 rupees per dirham. Multiplied with, what will I do? Inflation of base. Base means, here what is the base currency?
Dirham.
Dirham is the base currency. Let's say there was high inflation in UAE and inflation in India was only 6%. Inflation in UAE was 10%. Assume that. What will happen to the real exchange rate? Will the real exchange rate increase or decrease? Just see that. Inflation of which country is higher? Inflation of UAE is higher.
UAE.
If the inflation of a country is higher, then real exchange rate for India for dirham, what will happen to the real value of dirham? Its real value will be higher. Now, what is the effect of this? Well, you won't understand unless and until I put that in a real example. So let me put up this real example. Today, the inflation of US and UK is 100 at par. After 3 years, what is the inflation in US? 110, UK 115. But before that, can you tell me the exchange rate is of dollar 1.75 slash pound? This is the exchange rate of pound in terms of dollar. Are you getting it or not? Well, if you don't understand what is the base currency and what is the price currency, then there's no point. So what is the base currency here? This is the rate of pound, and dollar is your price currency. Yes or no? First thing first, I will write always this on the top of the question so that I don't get confused. Which country has higher inflation? UK. First of all, tell me, is inflation good for your economy or not? If you have higher inflation, it's not good, right? The prices of goods will be costlier, correct?
Yes.
Now, first of all, let me draw the real exchange rate. What is the real exchange rate? Nominal exchange rate. What is the nominal exchange rate of pound? The nominal exchange rate after 3 years was 1.6, correct? After 3 years, it was 1.6. The exchange rate given is nominal. Now I'm going to use the inflation of base currency. Which is the base currency? Pound. And divided by the inflation of price currency, which is US 110. Can you tell me what is the answer after solving this, please? Let me know the answer. 1 point. It should be more, right? Because the inflation is 67. 2 or 6727, you said, right? So
yes.
73. Now, understand one thing. If today you were to buy goods from UK, how much would you actually pay as per the today's exchange rate for 1 pound?
1.75.
To today means currently, and after 3 years, assume 3 years have gone, my mistake. Assume 3 years have gone. And if you want to buy the goods from UK, which is now 115, right? The same good, which was $100. So if you were, let's say the value of the good is 110 in US. So how much will you spend in US? If you buy from US, you will spend 110 divided by 106, correct? Clear? Yes or no?
Yes.
No, sorry. Let me correct.
110.
110. If I buy from US, it's going to be $110 only, right? Why? Because the price of good is 110. So I will have to spend only $110 fully.
Yes.
Clear? But if I buy from UK, what will I have to do? What is the value of the good in UK? 115 pounds. For one good, what is the value? 115 pounds. Can you tell me what is the value of 1 pound?
1.6.
$1.60 is the value of 1 pound. So can you tell me how many dollars will I have to spend to get this good from UK? If 1 pound is $1.60, how many dollars will I have to spend? Can you find it? Everyone? Or you all want me to do it? If you all want, I will do it. I'll repeat. 1 pound equals to $1.60. The goods value is 115 pounds in UK. How much would that be in terms of dollar? Can you find me that?
180.
184.
84.
Okay. How much was it before? How much was it before when it was 1.75? It should be little less, right?
Yes.
How much was it? Yes. When it was 100, how much did you spend? 100 into 1.75.
175.
So it was 175. Now see the situation, what has happened step by step. Okay. This is not completely easy concept. Give me some time to, give some time to understand this. So this means that US goods and services that cost, what was the cost of US for the US citizen before 3 years, which means at today's price, what was the cost of goods for the US citizen? They were buying at the base in the base period for $1.75 from UK. Correct? Now it costs them cheaper. And how much is that? $1.673.
0.
No, not 60. 60 is the exchange rate. But for you, what is the real exchange rate?
In 1.67.
So tell me, as a US citizen, before, compared to before, is it now more costlier to buy from UK or less costlier? Think. If I am a citizen of US, isn't prices in UK have increased relatively? Correct? So US goods have become cheaper. Now I'll tell you what exactly has happened due to this. So when the real exchange rate increases, here the real exchange rate, instead of 1.6, it became 1.673, right? So from 1.60, it became 1.673. So what happened? Now this is a careful thing. Where will the goods become cheaper? Tell me. Where will the goods be less expensive? Where it will be cheaper for me to buy? From US or UK? Just see there. If the inflation has risen for UK relative to US, just see the prices. Where have the goods become more costlier?
UK.
UK.
Right? So for a UK citizen, its goods prices have increased. So for UK citizen, it's a situation where they will find their goods costlier. So they will have to do what? They will have to import. And for US, it is going to be more valuable to sell to UK. So the exports for US will become what? Which country will find it exports less expensive? UK will find exports less expensive from US. So UK will find it cheaper to buy from US. I'll repeat, UK will find it cheaper to buy from US because the prices in UK have relatively increased more. Are you getting my point? Everyone? Where has the prices relatively increased more? They have increased more in UK.
UK.
So the conclusion is that for UK, getting goods from US will be relatively less cheaper. But for a US citizen, will it be more costlier? Just see the prices. If a US citizen wants to import from, if a US citizen, if he wants to import from UK, will it be less expensive or will it be more expensive?
More expensive.
More expensive.
More expensive. Now you would be wondering, sir, I did understand all this thing, but what is the connection here? Okay. Focus on the point of inflation. Which country had relatively more inflation?
UK.
UK. So the conclusion is that country which has more inflation, its goods become costlier and therefore it has to import, correct? And the country whose inflation is relatively less, it can actually sell the goods or export. So, Deepthi, can you read the conclusion here?
The country with the lower inflation rate will see
Lower,
its real
sorry, just to interrupt, lower inflation rate means in our example, US.
US
Yeah.
will see its real cost of foreign goods increase unless an appreciation of its currency offsets the inflation differences.
Hold on. So
Differential.
inflation differential. So for a US, the real value of goods from UK has increased. Instead of 1.6, its real value is now 1.673. Why? Because its inflation is relatively low. So I'll repeat, country which has lower inflation, in our example US, will find its real cost of goods increase. Means
Increase.
the real value of my good is more, but I'm paying less. Clear? Unless there is an appreciation. Here, if you see, the value of pound has actually gone down. So the conclusion is, higher the inflation in UK, higher the price inflation in UK, it has resulted in what? Increase real cost of UK goods. So the value of UK goods have increased to the US consumer. So US goods, US from the US consumer, if I were to see or analyze, it's easier for them to, if they sell to UK, they will make more money rather than buying from UK. Clear? So the exports for US will be able to export more, and UK will have to import more from US. Why? Because its inflation is increasing. Now, you know what? I somehow personally don't like this concept the way CFA Institute has presented. They should have rather presented it in terms of a concept called purchasing power parity. What purchasing power parity tells that country with higher inflation, repeat with me, country with higher inflation should find their currencies depreciate. So a country which has higher inflation here, UK, its currency should depreciate. Correct. Now just see what is the percentage change in currency. Can you find that? What is the percentage change in currency? 1.6 divided by 1.75 minus 1 into 100. Let me know what is the percentage change. Should I do it? 1.6 divided by 1.75 minus 1. Quick, come on. No? Don't you have calculators with you? .6 divided by 1.75 minus 1. I get 8.57%. You know, these days everyone has calculators, even you have phones. If you don't want to do it, that's a separate story. So 8.57 is the fall in, is the difference in currency. Correct. But the inflation is, what is the inflation difference? UK's inflation is 15%, US inflation is 10%. So I see the inflation difference of 5%. So ideally, if the inflation of UK is 5% more, its currency should have fallen by 5% only. Clear? But what I see that its currency value has fallen heavily more. So guys, when the currency value falls, is it good for US citizen or not? Well, it's good for US citizen. Why? Because the US citizen will have to pay less dollars to buy a pound. Are you getting my point? So for US citizen, they will have to spend less dollars for every pound. So US will benefit. Are you getting my point? Yes or no? So the countries with higher inflation should find their currencies depreciate. But if it has depreciated too much, then it is better for US to spend in UK. Why? Because they can buy more pounds with less amount of dollars. Everyone understood this concept? Conclusion: higher inflation should be adjusted in currency. If not, one of the country benefits compared to another. Clear? Now, the way that institute has presented this, I somehow disagree, but it's okay. What you can perhaps understand here from that, UK had relatively more inflation. So from the US, and that was not adjusted completely into the currency. So from the currency point of view, for US, it was more beneficial. Clear? So the real value of goods that you're going to buy from UK is more than 1.6. So you are actually getting goods worth 1.63 from UK by paying how much? Only $1.6. Clear? Clear? Yes, everyone? Well, that's nominal and real exchange rate. Now, before I go to a new concept, have you heard about something called cross currency? Have you heard about something of cross currency? Okay, tell me something. Tell me something that you want to take a flight from Mumbai to Canada. Is there a direct flight available?
No.
No. Why? Have you ever realized the reason?
Like not like to certain cities.
But why? Okay, let's say you stay in Calgary, right? So is there a direct flight available from India to Calgary?
Yeah, to Delhi.
Sorry?
Delhi.
To Delhi, but not from Mumbai to Calgary, right?
No.
Can you guess what could be the reason possibly for airlines not to start that? First of all, will they have too many passengers directly from Mumbai to specific Calgary?
No.
No. So availability is an issue. Okay. Second, if the airlines decide to start up a flight, even if there is less amount of people, what will happen? The costs will be too high, right?
Yes.
Because the flight won't be completely full. So availability and cost are two issues due to which there is no direct flight from Mumbai to Calgary, correct?
Yes.
So what do? You catch a connecting flight. Maybe you take a flight from Mumbai to Toronto or Vancouver, wherever it is. I don't know where you have a flight. Mumbai to directly, where do you fly?
Toronto, yes.
To Toronto. And then from Toronto, you may probably get a flight to your destination in Calgary or wherever, right? So you use a common destination to convert your route from Mumbai to Calgary. And that is called vehicle currency, or a common currency is called vehicle currency. So you do not, that's a third connection that you add, third route that you add between the two routes of Mumbai and Calgary, right? That connectivity which you add is called cross currency. Just imagine the case with currency. Now, let's say you go to your bank and you do not have Canadian dollars. Your bank does not have Canadian dollars. So what will you tell the foreign players? Let's say I'm an Indian importer. I want to buy goods from you. You are in Canada. You tell me, Kunal, I want payment in Canadian dollars. I go to my bank and my bank tells that we do not have Canadian dollars. So I will tell my bank, give me US dollars. I will give this US dollars to you and you will take this US dollars in your bank and convert it into Canadian dollars. Why? Because we did not have the currency. We did not have the currency. Or if the currency was there, at times it was costlier. So aren't this the same reason which I told you for flights? At times you don't have the flights, or if there is, it is very costly. So same way, at times, what if you do not have the currency available in your bank? And even if it is available, it is very costly. In such a case, we both may agree to deal in a third currency. That is what we call as a vehicle currency. Clear? Now, normally, this vehicle currency is the one which is easily available in your country and my country, which means it is very liquid in nature. Clear? And globally accepted like US dollar or euro or pound. Correct? So now check out this. What is the spot exchange rate? What is the spot exchange rate here? Can you see my screen, everyone?
Yes.
Yes or no, everyone? You all can see my screen, right? So tell me first, what is the base currency here? Euro slash USD. So USD is the base currency?
Yes.
Correct. And then I've kept USD slash GBP. So GBP or Great Britain pound is the base currency, correct? Yes, everyone. Now, this is a very old exchange rate where dollar's value was at one point of time more than euro. Right now, what is the situation? Euro's rate is more than dollar. Clear? Everyone? Right? Now, slight change I would want to do. I think I'll keep it as per the today's situation. So I'll do a minor change here. Just give me a moment here. I think I have done some error here. I'll do this as USD slash euro. Okay. EUR. And this I will put as GBP slash USD. Okay, sorry, my mistake. Okay, now tell me, what is the rate of, what is the first rate of? The first rate is of euro in terms of USD, correct? So 1 euro is 1.4550 USD. And the second quote is of dollar in terms of pound. Well, since the pound is higher, the value of $1 is less than 1, correct, in terms of pound. They have told me to calculate GBP slash euro, which means they want me to find the rate of euro in terms of pound. Am I correct? They want me to find the rate of euro in terms of pound. I'll repeat. GBP slash euro is the rate of what, everyone?
Euro in terms of pound.
Euro in terms of pound. Now just see the mathematical. Here, the vehicle currency was, the common currency was US dollar, right? So how do we do it in an easy way? First, frame up an equation. See, in order to get GBP slash euro, I will use GBP slash USD. I will require this, right? Correct. And if I multiply this with USD slash euro, just see the mathematical equation. What gets cancelled out? USD should get cancelled out, right? For that, USD should be in the denominator as well as in the numerator. Clear? Now check out everyone. Do you have GBP slash USD? Yes. Or no? Do you have USD slash euro? Yes. So simply multiply both, in this case 1.4550 into 0.9175 into 1.4550. This will give me 1.335. This will give me the rate of euro in terms of GBP. Are you getting it? Quote of euro in terms of GBP. Clear, everyone? Any questions, anyone? Now, if you want to understand it in another way, just see this. 1 euro equals to, I will write it here. 1 euro is equal to $1.4550. And $1 is equal to 0.9175 pounds. Correct? So let's say you want to buy 1 euro. How much dollars will you have to spend? Put in your calculator. Come on, quickly. How much dollars will you have to spend? 1.4550, right? Yes or no?
Yes.
For $1.4550, how many pounds you'll require? See, $1 is 0.9175. So can you find for $1.455, how many pounds will you require? Can you calculate? You'll get 1.335. Clear? Everyone?
Yes.
So it's the same thing I've put up in a mathematical equation. Now you have to be very alert. Tell me, what is the situation here? First thing first, what will we do? What is the first
Base
thing that we
currency.
do? Deep and Divesh, tell me.
Right. Base currency.
Yes, what is the base currency in both the case?
USD.
USD. What are we told to calculate the rate of CHF? CHF is Swiss franc slash NZD, that is New Zealand dollar.
New Zealand dollars.
So tell me, how will we frame up an equation of CHF slash CHF Swiss francs slash New Zealand dollar? Now, many of these guys would be wondering, why is CHF Swiss franc? It should be SFR, right? Well, it is SFR in English. In CHF, it's in terms of Swiss language. So what will be the equation? Can I say it should be CHF slash USD multiplied by USD slash NZD. Why? If I make this equation, only then the dollar gets cancelled. Clear?
Yes.
Now check individually. Do you have CHF USD?
Yes.
Do you have USD slash New Zealand dollar? No.
No.
Therefore, you'll have to inverse it. Are you getting my point?
Yes.
So I will keep the CHF USD as it is, 1.7799. But then instead of taking the value of 2.2529, I will take the inverse of it. So I will do 1 divided by 2.2529. Are you getting why am I doing the inverse? Yes or no? Why?
Yes.
Because what I wanted is not there. And if you want to prove me the same with another way, let me show you a technique. So by spending $1, how many CHF will you get? 1.77. Clear? And for the same $1, how many New Zealand dollars you get? 2.2529. Clear? So for one New Zealand dollar, you will have to give 1.7799 divided by, see, this will go on the other end, right? 2.2529. Why? Because both are for same value of dollar. So in $1 you get this, in $1 you get this. Clear? So you can find it in that way also. So first thing, you'll have to find what is the base currency. Second thing, what will you do? Second thing, you will make up the equation and see whether you have to do anything inverse or not. If there is no need of inverse like the previous quotation, simply multiply. If there is a need of inverse, first inverse any of the quotation that is required to inverse and then multiply. This is called cross currency. Is that clear, everyone?
Yes.
Correct. Let me show you some rates here. Okay. Now, I also want to not confuse you, but want to show you some international codes. Now, what is this format that CFA Institute uses?
Price/base.
The problem which I have with CFA Institute, for which I've written them a mail also, and they have not responded me properly, is that the global world uses what format? Base/price. Are you getting it? They use which format? Base/price. So the first rate is of euro in terms of dollar. The second rate is of pound in terms of dollar. Are you getting my point? No?
Yes.
So if I want to find euro/pound, which one will I have to inverse? First or second? Euro/pound. Which one will I have to inverse?
Second.
Second, right? So put in your calculator 1 point, and I want you to solve it, okay? 1.1872. Put this rate. 1.1872. Did you put?
Yeah.
Divided by 1.39028. Are you getting this answer? 0.8.
0.85. Yes.
Correct. That's called cross currency. Clear. Now this is what you can go to any live website and check out the rates. So if the bank gives you only these two rates, you can find the third cross currency rate. It's going to be always the exact same. However, the markets fluctuate very fast. So you will probably, by the time you look, the things will change. Now, I just wanted to show you that how it actually works, but I don't want you to get confused here because globally the world uses base/price, but unfortunately, very unfortunately, our CFA Institute only uses price/base. So for CFA exams, you will use which format? Price/base. The reason I'm explaining you this is that because I was very confused when I went into currency trading after my CFA. I was badly confused because what I learned was price/base format. What I saw was base/price format. Clear? Everyone?
Yes.
Now, some easy theoretical questions that I will do, that what are the functions of Forex market and who are the participants. Quickly we'll understand the functions. Well, the foreign exchange market is set up to what? To facilitate trade, foreign trade. What next? To not only facilitate buying and selling of goods, but also buying and selling of financial assets, capital markets. And many people who want to hedge currency exposure. So all those who feel that the currency value will increase or decrease and they can suffer huge losses, for all of them, you have currency markets, especially the currency derivatives market. So who all are the participants? Well, everyone who needs currencies. Individuals, government, companies, buyers and sellers of goods and services, they all need currencies. But there are some players who need currency for specific purpose, especially hedgers. Hedgers are the ones, basically importers and exporters. They are worried about for example, let's say I've sold goods to you today, but the payment will be received after 1 month. So I'm worried that the value of my currency will go down. So that's where I will have to hedge by using a forward or a future contract. Clear? Speculators are the ones who are betting where the prices of currency will go. For example, in 90s, George Soros was betting that the pound value will decrease. It did decrease and he made billions of dollars of profit. Then you have sell side and buy side. Sell side are those who are sellers or traders in foreign exchange. They are called primary dealers in currencies. They have the license to sell currencies, right? And mostly they are multinational banks. On the other hand, buyers are everyone. Individuals for traveling, tourism, corporations, investment accounts, governments, and retail market. So corporations, why do they require? Because they buy and sell goods abroad, right? For cross-border transactions. In the investment account, you have real money accounts that do not use derivatives. For example, when you buy insurance from abroad, when you invest in foreign mutual funds, that's all is real money account. Leverage account, on the other hand, are those used by hedge funds, private equity funds, and various other alternative investment funds. They do use derivative. Clear? So currency futures, currency options, they are currency derivatives which buyers use. Clear? Governments, yes, governments also play a large part in foreign currency, especially central banks buy and sell regularly currencies to control its prices. Sovereign wealth fund, pension funds, insurance companies, when they buy financial securities abroad, they do require foreign currencies. And retail market is where you and I need currency. For what purpose you and I need currency? For traveling, for tourism, for cross-border investment, or for simply speculative trading. However, speculative trading by retailers is generally prohibited in most of the countries. So you and I cannot have currency at our place, millions of foreign currency, and just keep it for just like that to get some investment return. No, that is not allowed in most of the countries. Trading in currency is generally prohibited, but banks can do that because for them it's a commodity. Correct, everyone? Any questions till this point, everyone? Okay, now we are going to deal with spot and forward exchange rate. Well, if you want to immediately buy and sell a currency, for example, let's say I'm traveling to Dubai in the next couple of days. So I will go to the airport and immediately exchange my rupee for dirham. That's immediate. I wanted immediately. That's called spot exchange rate. Correct? For immediate delivery, generally, in the currency market, the delivery can range from immediate or 1 or 2 days delivery time it takes. It also takes T+2. T+2 means you get delivery in 2 days. But a forward exchange rate is where I am going to sell you goods after 1 month and I will get dollar at that day. So I'm worried about the value of dollar. So I go to the bank and I book the rate of dollar today. That's called forward exchange rate. It's an agreement to exchange a specific currency in future date. That future date can be 30, 60, 90 day, 1 year, 2 year, whatever, right? Now that rate at which you fixed up your forward with the bank is called outright forward rate or outright forward contract. Clear? Yes.
Yes.
However, there are Forex traders. What Forex traders do? They regularly keep on buying and selling between spot and forward. So when you take a combination of spot and forward position in opposite direction, let's say you are buying spot and you sell a forward. This is generally done by Forex traders. That's called FX swap. FX swap is not a currency swap. Okay. Here FX swap means you buy one currency in the spot and sell the same currency in the forward, or vice versa. Maybe because of some trade benefits. That's called FX swaps. Generally, as an individual, I cannot do it. Clear? Everyone? Now, any questions? Anyone, please let me know. Anyone? Any questions? Yes? No? Okay. Either y'all are understanding everything or it's all bouncer. I know it's not that difficult, but do ask me if there is anything. Okay. Now, when you go to the bank gives you the quote. Listen to this, how the bank gives you the quote. For example, if I go to the bank tells me, Kunal, $1 rate is 72.5550 INR, Indian National Rupee, for spot delivery. And for 90-day delivery, the bank tells me that, Kunal, $1 rate is 73.1250 INR. Correct? Easy to understand. This is when banks give the rates to customers. Clear? But when banks deal with other banks, why do they deal with other banks? Because where do the Indian banks get dollar from? The Central Bank of India does not publish dollar, right? So they will have to open up a foreign account and get dollars from the foreign bank. Is that clear? Right? So to provide me US dollars, Indian banks are dependent on
Other banks.
the US banks to provide dollars, right? And simultaneously, US banks are dependent on Indian banks to provide their customers INR. Clear? Everyone, yes or no?
Yes.
So when I go to the bank and I deal with the bank gives me a proper rate because I am amateur and I am not a daily trader. But when bank deals with other banks, they don't give a full quote. They just give a half quote, which means they tell, so let's say I am a bank dealer in US and I call up an Indian bank and ask them, what is the rate? So they tell me that the spot rate is 72.5550 and 90-day forward rate is 20 points. What do they say? It's 20 points. What do you mean by 20 points? 20 points. They don't give me the full quote. They just tell me it's only 20 points. Or let's say they tell me it's only 2 points. Plus 2 points means 2 basis point higher. Now, what is 1 basis point? 1 basis point is nothing but 1 divided by 10,000. Clear, everyone? Into 1 if it is 1 basis point. So what is 1 basis point? 0.10. 0.0001, the fourth decimal. Are you with me?
Yes.
So when I say 90-day forward is 2 basis point, that means 90-day forward rate is 72.5552. I will have to add 2 at the last. Got it? Clear? Everyone?
Yes.
So every time basis point means the 10,000 term or the fourth decimal. How do you solve it? You will always do 1 divided by 10,000 first and multiply with whatever the basis they give. If it's 100, it's 0.01. If it is 15.5, it is 0.00155. This much you should add in this rate. Are you getting it? So if it's 18.3, in your calculator, do 18.3 divided by 10,000, you'll get 0.00183. Are you getting this? But
Yes.
what if it is 183? Do 183 divided by 10,000 in your calculator, you will get 0.0183. Clear? Everyone? Yes?
Yes.
Now let's solve this. What is this rate? Rate for, this is the rate of AUD/EUR. This is the rate of Euro in terms of Australian dollar.
Australian dollars.
They have told me to calculate the outright forward rate if 1 year, 2 year, 120-day and 21-day forward quote is 3.5 points or minus 55.25 points. First of all, 3.5 points. How do I write 3.5 points? I will have to do 1 divided by 10,000 into 3.5.
3.5.
Clear? In the same way, I will have to do 1 divided by 10,000 into 55.25. Are you with me, everyone?
Yes.
Here it will be, then the next one will be in percentage. I'll show you the percentage job later on. But here, what is the spot rate? 0.7550 plus I will do, sorry, my mistake. 0.7550 plus. Why do I do plus? Because it's plus points. But guys, when it is given minus, I will have to subtract the basis point. Clear? So in your calculator, you can do 0.7550 plus 0.00035. You can do that. You'll get 0.7554. Let me know. 54 means
Yes.
you'll get 0.0755
5535.
to be precise. This one you will get 0.7494. To be precise, how much you will get if you go for 6 decimal? You'll get 74. I think 945. You'll get probably. You'll get 945. Just check it. I'll do it. 55.25 divided by 10,000 minus 0.755. 749475. Are you getting this? You have,
I think it's set to 4 decimal.
Yeah.
I think.
Correct. If you set to 6 decimal, it will show you this. No problem.
Okay.
Now, at times they give in percentage. Percentage negative. Negative means, see, here the spot rate is 0.7550. Correct. From that, I have to subtract how much percentage? 0.025. So that, how do I add and subtract in factors? I will do 1 minus 0.025 percentage. Clear? I will get this answer. And when I add 1 plus 0.03 percentage, I will get this. Clear, everyone? Yes. So this is how, when you add or subtract basis point, whether they give in numbers or percentage, you get the final rate. That rate is called outright forward rate. So when it is added, it means the rate is appreciating. When it is subtracted, means the rate is depreciating. Correct? Everyone?
Yes.
Okay. Moving on. Now, focus on this rate. What is the spot rate? What is the spot rate of? Whose rate is it?
Euro in terms of yes.
Euro in terms of dollar. Right? Spot rate of euro in terms of dollar is 1.41. Later on, I mean, on the same date, if you ask the bank, what is the forward rate? The bank is telling that the spot is 1.41 and the forward rate is 1.45. So is the bank quoting for forward more or less for euro?
More.
More, right? That's why we say euro is at premium. Premium? I get many students saying, sir, euro is appreciating, right? Correct? So I have a lot of students confused between appreciation and premium. What do you think? This is an appreciation or premium? What is appreciation? Appreciation is when the spot rate today is more than the spot rate yesterday. Spot. Correct. So. Understand this thing, very important, okay? What is the date today? Let's say it's 1st of December 2021. Assume that. So on 1st of December 2021, the spot rate is 1.4150. And on 1st December 2022, the spot rate becomes 1.4550. So the spot rate over 1 year has increased. This is called appreciation. Are you getting it? This is called appreciation because this is between spot to spot on different dates. Are you getting it? Clear? Now, if I go to the bank today, let's say today is 31st of 2021. And I ask the bank, what is the spot rate today? And what is the 1 year forward rate today? So bank tells me today the spot rate is this and today the forward rate is this. Are there different dates? Same date. But the comparison is between? The comparison is between spot to spot, spot to forward.
Spot to forward.
Spot to forward on the same day, it means the dollar or whatever the currency is at premium in the forward. It's called premium. So guys, appreciation, depreciation, we discussed at the start of the session. Appreciation, depreciation was your last year and current year. It was just a spot rate from last year to current year. That's appreciation. Clear? But on the same date, if you find the spot and the forward rate different, it's called premium or discount. Is that clear, everyone? So can you, this is on the same day spot and on the same day forward rate. So guys, is the euro at forward appreciation or forward premium? What do I say?
Premium.
Premium. Clear? Because this is a comparison between spot and forward. How much is the premium? Can you find out? 1.4550 minus, what is the difference? 1.4150. Divide this by the base rate. What is the base rate? What was the rate before? 1.4150. Are you getting? Into 100. If you do into 100, you will get the premium. But this premium is only for 90 days, right? How do I annualize it? I will annualize. You know how to calculate annualized returns, right? How do you annualize? 360 divided by 90. Because this is for 1 quarter. There are 4 quarters. So we round it off. So in currency, we use generally 360 days. Can you find the answer for this, everyone? Calculate this and let me know what is the answer. 1.455. Everyone, I think you'll get 11.31.
Yes. Yes.
Okay. So what is the situation here? This forward was premium. Euro was at forward premium. But guys, how did I calculate forward minus spot over spot? So the difference between forward and spot divided by the base, that is spot, into 100. And then I annualized it. Therefore, this is called annualized forward margin. Now, this margin is nothing but this is the percentage difference between spot and forward, annualized difference. If this is positive, it is called premium. If it is negative, we call it as discount. So what should I conclude here? Euro. We are talking about euro, right? Euro is at annualized premium or discount? Premium of how much? 11.31% for 90-day maturity. For 90-day forward. So euro is at premium. So guys, dollar should be at discount, right? So I can write dollar is at an forward discount of how much percentage? 11.31, right? No. We know that it doesn't work in the same way. We'll have to calculate the discount. What will I have to do? I'll have to reverse the rates.
Reverse, yes.
So instead of 1 point this, what will my equation change? See this. Your entire equation will change now. I will write it down. How? You will have to do 1 divided by this minus 1 divided by this divided by 1 divided by this. So I'll show you how to calculate it, everyone. First of all, in your calculator, press 1.455 inverse and store it. Store 1. Got it? Then press 1.415 inverse and store 2. Store 2. Correct? So now the first one is recall 1 minus recall 2 divide by recall 2 into 100 into 360 by 90. You'll get 10.99 negative. That is almost 11%. So the discount is going to be of 11%. Clear? Everyone? Yes. So what is premium or discount? It's the difference between spot and forward on the same date. If the base currency's value is higher in the forward, it's called premium. If it's lower, it's called discount. Remember, whether you want to apply premium or discount, it is always for the base currency, that is euro in this case. If they ask you for dollar, you'll have to first inverse it and then calculate. Point number 1. Now, did you annualize the appreciation or depreciation? Did you annualize it? Did you annualize the appreciation or depreciation, guys? No, you did not annualize it. You kept it as it is. Clear? But the premium discount is always annualized. Are you with me, everyone?
Yes.
Premium discount is always annualized. That's why we call as annualized forward margin. So you have to put this annualized function, and if they don't mention you, you can keep 360 days. Otherwise, they will mention you how many days you should put. Is that clear, everyone? Correct? Yes. So this is a situation for premium and discount. Okay. Okay. So clear, everyone, with annualized forward margin and basically premium and discount, and why is it annualized? Okay.
Yes.
Now I'm going to come up to this point in a while, but before that, I would want to connect what we did in the previous topic. with respect to international trade, that is especially export import, and its connectivity with the savings and investment. Okay, so now we just completed this in the previous section where we understood that how X minus M, that is exports minus imports, have an impact on savings and investment. Now, I'm going to discuss about the arbitrage and parity and everything, but I will directly go to this point, which we actually were doing in the past section, in the previous section. I'm going to connect that and going to use two approaches. So from the previous section, we got X minus M equals to private savings and government savings minus investment. So what did we come to know? That current or current account deficit or trade deficit is compensated by capital account surplus, means you get foreign investments. Clear? Now see this here. If X minus M is positive, what do you mean by X minus M is positive?
More exports.
More exports. That means you will have more money. So that will lead to positive S minus I, means your savings will be more than investments. And the government will also get more revenue. So that will be more taxes compared to the spending. So basically what will happen? Both will increase. If X minus M is positive, your savings or your government spending both will increase. Government taxes will increase. Clear? This is a situation where there is a trade surplus. If the trade is negative, if there is a trade deficit, then on the other hand, if X minus M is going down, the right hand side also should go down, which means there will be a budget deficit. Budget deficit means government will have less taxes compared to the spending. And therefore, private savings will not be sufficient to meet our private investment. So therefore, you will have to do what? Your savings will not be enough to do the investments. Therefore, you'll have to rely on foreign investments, and therefore you'll have to borrow externally. So the conclusion is that if your trade is at surplus, you will have what? If your trade is at surplus, you can probably invest abroad. If your trade is at deficit, you'll have to borrow from foreign country. Clear? Now, the thing is that exchange rate between two countries is expected to change significantly. This trade will impact the exchange rate. So if the exchange rate between two countries do not stand constant, if they keep on continuously changing, what will happen? The investors will sell currency which is expected to depreciate and buy currency which is expected to appreciate. That's what they will do trading, right? If you expect too much of volatility, if you expect one currency to, you can do probably an arbitrage, you can do a speculation. You can sell currency which are expected to go down, and you can buy currency which are expected to go up. Asset prices and exchange rate adjust so that the potential financial capital is mitigated and actual capital flow remains constant with the trade flows. Now, what does it mean? When the prices of currencies are going up and down, the asset prices will also fluctuate, isn't it? Clear? But what will eventually happen? So if, let's say, the currency value of India goes down, then assets become cheaper in India? Yes or no? It's going to be cheaper for a US citizen to buy goods from India, right? Or to buy properties in India, because they will, for every dollar, they'll get more rupees, isn't it? So capital flow will increase. Are you getting my point? Clear? So conclusion is that when the currency value goes down, the capital flow should increase. That's how it should balance. Clear? Now, to understand this in more detail, there are approaches to exchange rate and trade balance. There is a connectivity between exchange rates and trade balance. There are two approaches: the elasticity approach and the absorption approach. I'll discuss in a while about both. It's slightly not complicated, but you'll have to keep a focus here. What these both approaches will tell you: the connectivity between exchange rate and trade. You remember the Chinese example that I told you? How China dominates the international trade? with respect to currency.
By the currencies.
So there is some connectivity between international trade and currency. We are going to see that. The elasticity, you know elasticity, right? Sensitivity of goods in terms of price. It focuses on the exchange rates, focuses the impact of exchange rate on total value of imports and exports. So elasticity focuses on trade, that is, it has a microeconomic view. But the absorption approach focuses not only on trade, but also on the capital flows. So it has a macroeconomic view. It has a more broader view. Now, what is elasticity's approach? Let's see that. See this equation. As per the Marshall-Lerner condition, what is this equation? Wx and Wm. Wx and Wm. These are the share of exports and imports. Share of exports and import in your total trade. Let's say in your total trade, exports are more. So the weight of export will be more and the weight of import will be less. And Ex and Em are price elasticities of foreign demand for your goods and domestic demand for imported goods. So basically E of X is price elasticity for export and E of M is price elasticity for imports. Clear? Now they are saying that a condition that guarantees devaluations improve the trade balance. Do you remember what I told you? Devaluation, when your currency's value goes down, Chinese goods become more cheaper. Correct? In the international market, you recollect that? So that was Marshall-Lerner approach, where they said that when the currency value goes down, your exports increase more than your imports because the price of goods fall more. So with higher price elasticity, there will be more demand compared to the loss that you will have in imports, because imports will be less sensitive. So higher elastic demand for imported or export good makes it more likely that the trade balance will improve given a currency depreciation. Clear? As the initial trade deficit gets larger, trade deficit gets larger means what is higher? What is higher? Come on.
Imports.
Imports are higher, right? They are saying the elasticity of import becomes more important and export elasticity less important. So what will happen in such case? That imports will become very crucial. So if more and more prices increase, imports will fall drastically, but exports will not fall as much. Okay, so in fact, exports will rise. Overall, currency depreciation will have a greater effect on the balance of trade when import or export goods are primary luxury goods. So for luxury goods, what will people do when there is a currency depreciation? They will import less and your exports will increase more. Especially goods with close substitutes and goods that represent a large portion of your overall spending. So just see a situation. Initially, when there is a devaluation of currency, what is happening here? What is happening when there is a devaluation of your currency? Initially, what happens? The trade deficit takes a downturn. The deficit increases, right? Correct. But later on, what happens? Imports fall more compared to export. So then the trade balance will eventually become positive. So in the long run, if you see devaluation of your currency leads to trade surplus, which means your exports will be more than imports. This curve is called J curve. Why is it called J curve? Because initially a currency depreciation will make the trade deficit higher. Later on, importers adjust over time by reducing quantities and Marshall-Lerner condition takes effect and the currency depreciation begins to improve trade balance. So you know what? When the foreign goods prices increase continuously, this is what US did. Due to OPEC crisis, the crude oil prices increased drastically in US, right? So then US realized that it's time for us to not rely too much on the Gulf nations and start producing crude ourselves. So you know what US did? US started producing crude oil gas with respect to shale gas. And what happened now? US is self-sufficient. So now US is not worried about currency depreciation. In fact, that helps US. Clear? So in the short run, there is increase in deficit followed by a decrease in when the Marshall-Lerner condition is met, referred to as J curve. This is exactly how US dealt with the crude crisis. So in the long run, in the short run, what will happen? Currency depreciation will widen your trade deficit. But in the long run, it is going to benefit your economy. Clear? Because you will adjust the imports by domestically producing. So currency devaluation is beneficial in the long run. Clear? Now the second approach also focuses not only on trade but also on the capital. So elasticity approach ignored capital. Absorption approach includes a macroeconomic viewpoint and therefore it focuses on capital. So your balance of trade is a combination of domestic production of goods and services. Correct? And it also includes E, which is domestic absorption of goods and services, which is nothing but total expenditure. So they are saying balance of trade is production of goods and services, and the difference, not only the production, but also the absorption. So what is the outcome? For balance of trade to improve, domestic saving must increase relative to domestic investment in physical capital. Yes. So if you want your balance of trade to be positive, what should you do? Your local investment should be, you should be what? You will invest.
Saving should increase.
Yes, you will invest a lot in your economy, so your saving should increase. Thus, for a depreciation of domestic currency to improve the balance of trade, it must increase the national income relative to national expenditure. So your country should start saving more if you want balance of trade to improve. Currency depreciation cannot improve the trade balance unless it is also induced by a corresponding change in capital account. So either your saving should increase or you should get capital from abroad, which means you should get FDI. Clear? Saving must also be willingly channeled into buying financial assets from foreigners. If there is excess capacity in the economy, then by switching demand towards domestically produced goods and services, depreciation can increase the output or income. Now, this last line I'll repeat. What China has excess capacity of everything, correct?
Yes.
Right. Now, what has Chinese companies been doing? The Chinese companies have been not only producing for their demand, right? But they are using this excess capacity to export, and here currency depreciation helps. That you are self-sufficient in your home production. So there's no issue of price appreciation, right? And by depreciating your currency, your goods become very cheaper to the foreign buyers. So excess capacity, you ensure that your country consumes from your products, and whatever is the excess capacity, you sell it. And in this case, the currency depreciation will help. So basically, what is the absorption approach? The absorption approach also focuses that it is also capital which helps, increase the effect of devaluation. So how does it help? That you can increase your savings, or you can bring in foreign capital, and that will perhaps help the devaluation take into more better effect. So all in all, both the approaches tell me that currency devaluation will eventually increase my trade. Clear?
Yes.
Now, we understood what was annualized forward premium or discount. So premium or discount was the percentage difference between spot and the forward rate. Correct? Okay. Now, let me give you an example before I discuss anything else. Okay. Let's say currently $1 equals to $1 equals to 50 rupees. Let's assume that. Okay. $1 equals to 50 rupees. And interest rate in US is 3% and in India it is 10%. Interest rate in US I've put 3% and India 10%. Okay. Now, what is the difference in interest rate? 7%.
7%.
Which country has more interest rate?
India.
India, right? So naturally, a lot of people will borrow from US and put
US.
it.
Yes.
Correct. But I've showed you in the past that we live in a country, we live in a world where you have 0% interest rate in few countries and 100% interest rate, 200% interest rate in few countries, 60% in Venezuela and all. So why doesn't US invest everything from US to Venezuela? Because of currency. So naturally, it looks like that, you know what you should do? All US citizens should borrow from US at 3% and invest in India at 10%, right? How much will you make?
7%.
7%. That's the reality, right? But will you actually make 7%? If that is the case, everyone would do that, right? US will print all its currency and invest in India, isn't it? But this money gets lost in the transit. It gets lost in the currency. After 1 year, when you will take back the money, your 1 year forward of dollar will be adjusted in such a manner that you will make no gains, no loss. What does it mean? Let me tell you. So $1 was how much? 50 rupees. Correct? After 1 year, $1 will become how much? $1 will become how much? Add 3%. If you borrow from US, add 3%. It will become 1.03. Clear? Yes or no? $1 will become how much? $1.03. Yes or no? After 1 year, because of 3%. And 50 rupees in India after 1 year will become 50 into 1.1. That is 55. Correct? So what should be the value of $1 after 1 year? In your calculator, put 50 into 1.1. 50 into 1.1 divide by 1.03. You'll get a value of 53.398. That is 53.40 approximately. Correct? Yes or no?
Yes.
Yes.
Now, can you find me what is the percentage change from spot to forward? What is the percentage change from spot to forward? How will you find that? You know how to find that, right? Basically, I'm telling you to find annualized forward premium. How will you do that? 53.4 minus 50 divided by 50 into 100. How much do you get?
6.8.
6.8.
6.8. So dollar has appreciated approximately, or I can say rupee approximately, okay? Or rupee has depreciated by how much? Approximately by 7%, isn't it? Now see this. You went from US to India to invest, correct? For how much extra money? How much extra money? 7%, is it? But in the same period, the currency, Indian currency got devalued or depreciated or fell down by 7%. So whatever extra that you wanted from India got lost in the currency. Eventually, no gain, no loss. That's called no arbitrage price. So what should be the currency price of 1 year forward for dollar so that there is no gain, no loss? To prove that, let me again put this. Again, put all of this into the equation. What was the situation that we had? I had given you the dollar in rupee interest rate, right? What was the dollar rate? 3%, and the rupee rate as 10%, 3 and 10, right? Correct. Now let's say you borrow $100 from US. At the spot rate 50 rupees, you convert that. How many rupees you will get? 5,000 rupees. After 1 year, how much do you have to pay in US? At the rate of 3%, you'll have to pay $103. Clear? Yes or no? And the 10% investment in India will become 5,500, correct? Did you make more money or not in India relatively?
Yes.
But after 1 year, the currency will adjust in such a manner that you will make no gains, no loss. So what should be the currency rate such that there is no gain, no loss? That's called interest rate parity. That's called the rate as per interest rate parity. So in your calculator, put 5,500 divided by 1.0 divided by 103, you will get a rate of 53.40. Wasn't this the same rate that I discussed? Correct. Check it. What did you learn from this? What did you learn from this? Tell me. You learned an important thing. I'm
You
sure.
don't gain anything.
Yes. So the interest rate difference gets adjusted in the currency. So can you tell me which country's currency rate has increased? Dollars rate has increased or decreased?
Dollars is increased.
Dollars rate has increased because the dollar's interest rate is low. And by how much percentage? Approximately the same. The difference, 7%. Interesting it is, isn't it?
Yes.
Now let me show you this. Now, can you read this statement, Deepthi? What we just did?
When currencies are freely traded and
there is no restriction. Okay. Oh, see,
arbitrage.
What was the condition of arbitrage? You remember arbitrage? No restriction. So no arbitrage means no gain, no loss. Correct. That's what we saw. But it also means that there is no barriers. So here we assume that there are no restrictions. You can buy and sell currency from any country to any country. Okay. So when currencies are freely traded and forward currency is there, which means there is derivatives. So then what is the conclusion? Read this. The
percentage difference between forward and spot exchange rate is approximately equal to the difference between the two countries' interest rate.
Yes. So I will write this in an equation. What is the percentage difference between spot and forward rate? That's called AFM, annualized forward margin, isn't it? Correct?
Yes.
That should be the difference between interest rate of both the currencies. That should be equal to the interest rate difference. Now I will show you this with an example. So after this, we will get a rate. So here, how did I get 53.4? See this, how did I get 53.4? You have to pay very much important attention, okay? Otherwise, you'll never understand this concept. What was the spot rate? $1 was 50 rupees.
50 rupees.
Correct. Later on, what did I do? I increased 3% on a dollar. So $1 into 1.03 became 50 rupees into 1.10. 1.10 is the interest rate in India. So after 1 year, what happened to the dollar? 1 year forward for dollar, I will write it as 50 rupees into 1.1 divided by 1.03. So this $1 forward rate, what is the forward rate? What is 50 rupees? I can tell you it was a spot rate into 1.1. 1 is the interest rate of which currency? 10% is the interest rate of
India.
India. That was, can I say India was in this case price currency and
Yes.
dollar was the base currency.
Base currency.
This will give you the forward rate. This is called IRP, interest rate parity. Interest rate parity. It is a rate which sets off the interest rate difference. So 53.4 is such a rate that takes into consideration the interest rate difference between both countries. Got my point? So here, what is interest rate parity? Forward rate is nothing but the spot rate into interest rate of price currency divided by 1 plus interest rate of base currency. So what is the spot rate of INR/USD? INR/USD is, what is the base currency here?
USD.
USD. I have been given the spot rate. I have been given the 1 year rate of INR, 1 year rate in USA. So can I find the arbitrage free, means no arbitrage, parity rate of 1 year forward? They've asked me 1 year forward. How will I do that? Okay, what is the forward rate? How will I find spot rate? 72.2550 into the interest rate of price currency, that is India, 1.1 divide by base currency 1.03. I'll get 77.1655. Just check it if that is the answer.
Yes.
Now, if I tell you to find AFM, you know how to find AFM. AFM is forward minus spot, correct? Divided by spot. Can you do divide by spot again? 72.2550, correct? Into 100. And see, this is already annualized, so you don't have to be worried. It's almost 6.7. So it's almost 7%, isn't it? Correct?
Yes.
Now this 7% is nothing but the difference between the interest rates. See that the interest rate difference between India and US is 7%. So what 7% you went extra to earn from India, that 7% gets lost as India's currency goes down by 7%. So the conclusion is that the currency with which currency had higher interest rate here? India.
India.
Currency with higher interest rate should appreciate or depreciate? Should its value increase or decrease?
Depreciate.
Depreciate over time by approximately the same amount as interest rate difference, isn't it? Therefore, if you would see, I'm not going into exact calculation because the parity is based on approximate calculation. So we never do exact calculation. So approximately let's say if US interest rate was low compared to India, that means US currency will appreciate in the future, or it will be trading at a forward premium. Clear? Yes or no, everyone?
Yes.
So if you look at the global interest rate, which I've given the link here, whichever country has relatively higher interest rates, their currencies should fall. So Turkey, Venezuela, Iran, their currencies fall a lot. Their currencies depreciate by what percentage? By the same percentage as the interest rate difference between them and, let's say, US dollars. Clear? Everyone? This is called interest rate parity. So interest rate parity states that the rate is such that the forward margin or the forward premium or discount should be equal to the interest rate difference. That's called interest rate parity. Is that clear? So anytime you see two countries currency rate, and if one country is higher than another country's currency rate, that's only and only because of interest rate difference. Is that clear, everyone? Correct?
Yes.
Any questions? So if the India's interest rate is increasing compared to Canada, if India's interest rate is going to increase compared to Canada, then Indian currency's value should depreciate, or Canadian dollars value should appreciate. By what percentage? By the interest rate difference. If this does not happen, there are arbitrators who will ensure that this happens. Correct? And the currency market is too huge so that there are various arbitrators to do that. So my conclusion is that will government will be able to always control the currency only if it has good amount of reserves. You remember Chinese discussion of reserves? If you do not have reserves, can you control the currency? No. So how does a country operate? How does a country manage the exchange rate? Do you want the exchange rate to fluctuate a lot?
No.
If it fluctuates, then the exporter or importer will never be able to trade with certainty, right? So every country has their own exchange rate regimes or exchange rate systems. And you know who deals with the monetary policy? IMF. So IMF has categorized the exchange rate system globally in two parts. First, there are countries which do not use their own currencies, and second, countries that use their own currencies. So there are two types of countries that do not use their own currency. They do not use their own currencies means they either do dollarization or they form a monetary union. Dollarization means you do not have your own currency and you make dollar as your currency. Clear? For example, Zimbabwe, Panama, Kosovo, Montenegro, they do not have their own currency. So they make euro or dollar as their currency. Clear? They don't have their own currency. European Union is a classic example of monetary union where we all are a part of one common currency, that is in EU, everyone has adopted one common currency, that is euro, right? Now, for example, Italy, initially it had Italian lira. Now it does not have its own currency, but it has become a part of euro. Correct? Germany had Deutschmark, but now it does not have its own currency. It has become a part of euro. So either you adopt someone else's currency or you all form a common third currency. Is that clear, everyone? Yes or no?
Yes.
Then on the other hand, you have 7 types of different sections where we issue our own currency, but we follow a system. Now, whatever I'm going to read, they all get summarized into 2 systems, fixed and floating. Fixed means we fix the rate of currency. We don't let it change. Floating means we let the market participants, that is demand and supply, to decide the rate of currency. But remember, for fixed exchange rate system, you need to have enough reserves. And if you keep on floating, it can go haywire. So most of the countries fall between the extreme. I repeat, most of the countries fall between the extreme. No one has complete exact fix or exact floating. They do have some intervention. Okay. Now, what are those changes? Let's see that. So the first is currency board arrangement. Now, this is more of a fixed rate. Fixed means peg. This is a commitment to exchange domestic currency for a specified foreign currency. Means you have decided that how many my currencies will be equal to your currency. This is fixed. Currency is only issued when fully backed by holdings of equivalent amount of the foreign currency, that is dollars. For example, Hong Kong, Djibouti, Bulgaria, Bosnia, or Brunei, they have fixed exactly their value against US dollar or any other currency. So their currency rates will not change at all. Clear? This is an extreme case of fix. Everyone cleared? Very few countries have this. Got it? Everyone? Understood? Yes or no? Now, there will be some flexibility here. So you have conventional fixed peg arrangement where you let the currency change by around some small margin, 1%. So till 1%, you let it change. But if it goes beyond 1, you intervene. You means the central bank. Correct? So either the margin is small or the margin is wider, which is called target zone. There is hardly any difference. In fixed peg arrangement, the margin is very small. In target zone, it is kept in some target. Clear? UAE, Qatar, Saudi Arabia, they all have pegged their currencies against dollar and they let it change minor. If it changes too much, then they intervene. Correct? Everyone? So you never find dirham's rate or Saudi riyal's rate or Qatari dinar's rate too much different from the US dollar's changes. So if the US dollar has changed by 10%, their currencies will also change by almost same. Got it? Clear? Now the next step is crawling peg. So peg means fixed. So it crawls, means it moves. So it gets adjusted periodically. That's why it's called crawling. So if, as per the inflation, they keep on changing the band. So very few countries called Nicaragua or Botswana, they have a crawling peg. Now managed means there is an intervention by the central bank. So here the managed crawling pegs are very much similar to crawling pegs, but they are deliberately increased or decreased over time by the central banks. Most of the countries, especially China, Ethiopia, Uzbekistan, Armenia, Switzerland, or Croatia, they have a managed peg. Are you getting it? So they let the currency move in a band. Clear? Right? Same way you have managed float. Float means you let the currency float. You don't interfere unless and until it becomes too essential. So your attempt is to influence the exchange rate only if there is a specific indicator. Otherwise, you let it float. So it's a more flexible system, right? So many countries have a more flexible system like Malaysia, Pakistan, Sudan, and Russia, which I've mentioned here. But the most flexible system is independently floating. Independently floating means the rate is completely decided by demand and supply. Governments hardly, very minor influence they have, and that too for a very short term. Most of the developed economies or stronger currencies have this system. Australia, Canada, Chile, Japan, Mexico, India also has this system. Even the UK and the US have what type of a system? What type of a system? Independent floating system. Clear? You know what is my observation? Fixed means controlled by? Fixed means controlled by? Controlled or not controlled by central banks?
Control.
Control. And floating means completely market determined, right? Most of the democratic nations have independent floating system because their people rule, the demand and supply rules. And most of the monarchies or communist governments or autocratic or one leader government, one party government, they have somewhat intervention like peg or crawling peg or target zone. Got my point? All the democratic nations let their currency float as it is. Only if in extreme situation they intervene, otherwise they don't intervene. Clear? This example are just for your references. What you need to understand is two systems. Flexible means independently floating, and fixed means some form of intervention. Correct? Everyone?
In the managed crawling peg, so there is a band.
And that band is regularly changed. That band is not going to be fixed. That band will be changed over the period by the central bank. So right now the central bank has decided that we'll let the currency float in between, let's say, value of 50 and 55. That's our band. But over the period, you may let that band be between 57 to 60 or 45 to 48. So that will be decided by the central bank. So it will be somewhat in the range, and that range will be keeping on changing. Okay.
Okay, so the target zone will have a fixed, like 2%, then it's going to be the
Right.
fixed.
Right. So it will be in that range only. The range will not change.
Okay.
If the range is
Okay.
very small, then it's called a conventional fixed peg. It's
Convention.
not fixed.
Okay.
Correct. Well, that's it. That's the end of our topic. Very, very important topic. You will definitely have questions from appreciation, depreciation, direct quote, or cross currency, or parity. These are the questions that you will very often see in exams. One or two questions you will have, but you will surely have. Whatever examples I've given you, these examples are far more than sufficient for your practice. Everyone clear?
Yes.
Okay, that's the end of I'm sure you must have found economics very boring because it has a lot of theory. So that's the end of economics. And you have any doubts, let me know, or we'll meet in the next section and I'll discuss with you about the schedule and everything about the next section. Okay. Anything with respect to economics?
Nothing so far.
Okay. So thank you so much for everything. And we'll meet in the next section with anything remaining, if any. Okay. Clear?
Yes.
Okay. See you. Bye-bye. Take care.
Yes.
Bye.
Thank you.